hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It's a Wednesday morning. It's a rainy morning out here in Mumbai, but of course, the same can't be said about the Lal Street, given the fact that we've seen records raining on the Lal Street over the last 4 days, so to say. The Nifty has managed to clock a fourth straight day of record close yesterday, and this morning, nothing is different, given the fact that the GIFT Nifty is hinting at a start above that 20,600 mark. So yes, we are bracing for record highs once again this morning, but the good part this time around is the fact that the Nifty Bank Index has started participating as well. It closed above that 50,400 mark decisively, and technical experts are of the view that this level of 50,200 has been taken out, so now the trend could be on the upside. But of course, we'll be posing that question to our technical expert a little later on the show. We'll also be getting you a big voice. Ajay Srivastava will be joining in and sharing his thoughts on the market, and of course your stock related queries will be answered by our experts as well. So if you have any queries, keep them coming in on our YouTube feed. We'll try and get them answered. But before we move any further, let's take a quick look at the top stories at this hour. Wall Street notches yet another record close. The S&P 500 and Nasdaq rise to fresh highs as Nvidia rally continues. The AI chip maker takes Microsoft's crown as the most valuable company with a market cap of $3.3 trillion. Asian markets trade largely higher on a strong handover from Wall Street and stronger than expected Japanese exports. The GIFT Nifty, as I mentioned, is hinting at a higher start for the Indian market. Crude prices firm up further. Brent rises above $85 a barrel on expectations that rising summer demand in the United States will draw down inventories. And a flurry of block deals likely today. Sources suggest that Vodafone Group has increased Indus Towers block offer size to $1.8 billion. In fact, block deals are also expected in the likes of Gland, Pharma and Z commercial vehicles. Sources say that Craftsman Automation has launched a 1,200 crore rupees QIP, and Ami Organics 500 crore QIP is also open for subscription. On that note, let's quickly take a look at the cues for trade this morning. Of course, as I mentioned, the Nifty has posted a record close for a fourth straight day, and so has the mid-cap index. In fact, mid-cap index has been on a gaining spree, a record-setting spree, so to say, for a sixth straight day yesterday. The Nifty Bank Index, that will be in focus. It gained somewhere around 440 points yesterday to close above 50,440. And, ICICI Bank, HDFC Bank were among the biggest Nifty contributors yesterday. So will the Nifty Bank Index lead the rally from here? We will be posing this question to Rajesh Palviya of Axis Securities, but also want to mention defense stocks continue to see buying interest. Stocks rose as much as 10 to 15% yesterday as well. But let me first get on board Rajesh Palviya. Then on that note, Rajesh, great to have you on the show. 23,600 on the chart slightly, and good news in terms of the Nifty Bank Index. I think, that has managed to shut shop above 50,400. A crucial resistance level broken on the upside. What are the levels you'll be watching out for, particularly on the Nifty Bank Index, given the fact that it's the weekly expiry today, and 51,000, could we reclaim that level in the next couple of sessions?
Good morning, Nandita. So definitely Bank Nifty managed to give breakout of its major call concentration area of 50,200. So again, we may witness a short covering action in today's session also, as we have a weekly option expiry. So call writers are forced to cover their position, and possible rally can extend. 50,800 to 51,000 could be there in this continuation of this rally for Bank Nifty. So yes, your trade should be on the long side at this moment. Stop loss should be placed at 50,100 to hold long position. Even on the Nifty also, 23,400, 23,500 attracted more put writing activity. So that clearly shows that, here base is also shifted higher. So possible rally for Nifty also can be there, and we can see a level of 23,600 to 23,700 in the continuation of this uptrend. So both indices are looking bullish. One should remain on the long side of trade at this moment.
All right, remain on the long side, but the stock of the day would be, according to me, Indus Towers and Vodafone Idea. Of course, Vodafone Group is looking to sell a stake in Indus Towers via block deal. Sources suggest that the offer size has been raised to $1.8 billion vis-a-vis $1.1 billion. Now, Vodafone will be selling somewhere around 18% stake in Indus Towers. For the day, is there a trade? How should one navigate stocks like Vodafone Idea as well as Indus Towers?
I think Vodafone Idea is in uptrend, and looking at the breakout on the near-term structure, we believe that if it continues to hold above 16 level, then possible target for we can see towards 18 to 19 kind of level. So I think trade should be on the long side for Vodafone at this moment. Your stop loss should be placed at 16 rupees. For Indus Tower, again, the stock is now struggling to cross its multiple supply zone, which is placed at around 350, 355 zone. If at all stock crosses those level, then we can see some rally. Otherwise, we may see some consolidation. On the downside, the major support area is placed at around 325. That needs to watch closely in Indus Tower on the near-term perspective.
Just also want to point out that according to Nuvama, as a result of this block deal, if the math is correct, the passive flows could be to the tune of somewhere around $200 million or thereabouts. But aside of that, what would you be keeping on your radar, Rajesh, for today, or with a 1 to 2 week perspective in terms of recommendations for viewers?
So I think housing finance sector is looking very bullish, and the Canfin Home is looking very strong. The way stock managed to give breakout of almost 12 to 13 month consolidation range on monthly chart, it clearly shows that here we can see a rally to a continuity of a rally. Possible target on positional perspective we can expect towards 940 to 950 on the higher side. Your stop loss should be placed at around 860 to buy Canfin Home. The second stock that we like is from Pharma space, that is Cipla. Looking at the structure, series of high top, high bottom formation is taking place. Stock is trading at all-time high. Stock is moving in up sloping channel. So all parameters are indicating that here we can see continuity of uptrend. Cipla target we can see towards 1630, 1640. Your stop loss should be placed at around 1545. And the third stock that we like is Coromandel. That stock is also showing a good continuity of uptrend. 1600 could be the next target for Coromandel. Your stop loss should be placed at around 1520.
All right, those were the recommendations coming in from Rajesh. Just let's take a look at the market open then, just shy of that 23,600 mark, but nevertheless it's a positive open. We are at record levels. Aside of that, take a look at sensex, 77,400, that's where it's perched at. The Nifty Bank Index, flat but with a positive bias, so we are round about that 50,500 mark as of now. In terms of sectoral movers, want to pull up the realty pack and see how it's doing. After last week's outperformance, it continued to gain. In fact, it was the top sectoral gainer yesterday, somewhere around 2% up in yesterday's trading session. Realty is a little bit under pressure, 0.6% kind of losses coming in there. India VIX has cooled off slightly, but sectorally what's doing well is the metal pack, that's up somewhere around 0.3%. FMCG is a close second. No big moves coming in just yet, but most of the sectors are trading with a positive bias. I want to pull up the shares of an Indus Towers. A block deal has happened in the counter, somewhere around 0.2% stake worth 120 crore rupees has exchanged hands at an average price of 330 rupees per share. Indus Towers, that's the stock I'm talking about. Let's see what kind of impact we are seeing on stock price. The shares are up in fact they are down somewhere around 2.5% at the current juncture. But in terms of other movers, on the Nifty, TCS is among the top gainers, and so is UPL. In fact, that's the biggest mover on the Nifty this morning. Tata Motors, JSW Steel, Tata Steel, Infosys, IndusInd Bank, ITC, Wipro. These are some of the other movers. On the losing end, Titan was among the top gainers on the Nifty yesterday. Today, it has come under some bit of selling pressure. Autos continue to be in a downtrend. Yesterday, most of the auto counters were in the red. So, Hero Moto, M&M, Bajaj Auto, these are some of the stocks that are under pressure. Looking at the open, in terms of stocks, Gland Pharma was one stock that is in focus because there were reports that Fosun Pharma would be selling stake of somewhere around 5% or thereabouts via a block deal. How are the charts for a Gland Pharma stacking up for you now, Rajesh?
So after this downtick, stock is now approaching to its 50-day moving average, which is placed at around 1790, which is important and critical support area for near-term structure. If it slips below to 1790, then possible follow-up selling action we can see in this stock, and then a lower target towards 1750 could be there. But on the higher side, the immediate resistance is placed at around 1850, 1860 zone. If stocks again, manages to cross 1860, then we may see some more consolidation as since last couple of week stock is consolidating in broader range of 1900 to 1780 kind of zone. So I think some more consolidation we can witness in this range only for some more time. And then once we get breakout above 1860, 1900 zone, then this rally can extend to 2100 to 2200.
All right, the block deal, has just about happened. 6% equity has exchanged hands, worth 1800 crore rupees or thereabouts. A flurry of block deals today, right? ZF commercial vehicle. That's another one where Babco Asia was likely to sell somewhere around 5% stake via a block deal. The floor price was at 14,980 per share, which was at a discount of 13.3% to yesterday's close price. Do you track this stock? I don't know how liquid this is really, but what would you be watching out for here? The floor price was at 14,980 or thereabouts.
So I don't track this stock, so I won't be able to comment on this.
Prestige Estates as well, the company will be mulling fundraise via QIP rights issue or preference issue on the 21st of June. In fact, it will also be mulling monetization of assets in the hospitality segment via issue of shares. Of course, there is a lot of buzz and, reports were suggesting that the hospitality business, will come out with an IPO pretty soon. But Prestige Estates has been hitting fresh highs, right, consistently. Today, I think it's cooling off a bit. What are the kind of resistance levels you'll be watching out for here on these charts?
So I think most of the real estate stocks are looking bullish, and again Prestige is one of the stock where we are holding our bullish view. The way stock is trading almost near to its all-time high trajectory, series of high top high bottom formation is taking place in this stock. Whatever minor dips we are getting in this stocks, buyers are ready to buy those dips. Looking at the near-term, short-term structure, the immediate resistance is placed at around 1940, 1950 zone. If stocks again manages to cross those levels, then again we may see a continuation of uptrend, and then possible rally can extend to 2200 to 2300 also for Prestige Estates. So buy on dip should be your strategy at this juncture. Your stop loss should be placed at around 1820 to hold long position.
Right, that's the view. Take note of the stop losses that Rajesh has mentioned. Z, that stock is also on my radar today. CFO Rohit Kumar Gupta has stepped down. The stock was attempting a good up move, right? Over the last 1 month, we saw somewhere around 9% kind of an up move. But off late, last 5 sessions, it has been, trending lower. Today as well, trading with a negative bias, but with a trading perspective, what should one watch out for here? Should one keep a stop loss of 145, 150, or should one keep a lower stop loss here?
So Nandita is still, for Z, trend is still on the bearish side, though some recovery is taking place in the stock from its recent low. But still, we believe that till stock not manages to cross over 175, 180 zone, the trend is likely to remain on the bearish side. And again, in the pullback, we may see supply pressure in the stock prices. On the downside, yes, 150, 145 are the immediate support area in the decline. So those who wants to play for very narrow price range, or because stocks is not moving anywhere, it's trading in a range only. So if you want to play for very short price action, then you can play in this stock. Your stop loss should be placed at 150 at this moment for trading position. On the high side, if it stocks comes near to 166 to 168, where you can book profit also.
One query then, I'll take up one query before I bring on board my next guest for today. This one is coming in from Satya CK, wants to know your thoughts on a GMR Infra. It has exited the F&O ban, the stock has been doing well. Here on the upside, what would you be watching out for? And if somebody wants to get in now, is this a good time?
So I think you should hold the position in GMR Infra. Very soon we may see a stock to move in three digits, and possible rally can extend to 110 kind of level also. So for trading perspective also, stock is looking bullish at this moment. We suggest here to keep your stop loss at around 95. Possible target 108 to 110 we can see in continuation of this up move.
All right, that's the view on GMR Airports. I hope that answers your query. Hold the thought. Rajesh will come back and take up more viewer queries with you. But let me also bring on board my next guest for today. The big market voice that I had promised at the start of the show. Joining me is Ajay Srivastava, the CEO of Dimensions Corporate. Great to have you on the show. Finally, Ajay.
Thank you, Nandita. Good morning.
How are you feeling about the market? You know, the election day slump is a thing of the past. We've been hitting fresh highs. But here on until the budget, do you expect any big moves, or do you think we'll consolidate around these 23,600 to 700 levels? What are your own thoughts?
Are you saying we don't have a big move? You just saw what happened to defense stock yesterday. It was tremendous. I think, the market has got a momentum of its own at this point of time. And I don't think to us budget is more important. I think what's more important is the GST meet. That will the much touted about rationalization come in place? Will the two-wheelers, the entry-level cars get a lower tariff? And will the highest 28% be tweaked down? I think those are important. The budget has got a little relevance to us because, income tax rate, a little bit here or there is not going to make a difference. What's going to make a difference is really the GST part. And I think that's where all the eyes are at this point of time. That, that if they finally bite the bullet and say the entry level cars, two-wheelers, everything has a lower tariff rate, and they want to bring the GST rationalization, that's the greatest move on the economy because that changes the dynamics. Tweaking of money between ministries, that doesn't change the dynamics so much. We know defense is going to get allocation. We will be getting lots of orders for defense. So that's nothing new news. The news is whether GST rates will go down, at least for the entry-level auto, because auto just spawns out the whole different economy altogether. So my eyes are mostly on GST more than even the budget.
Right, of course, you mentioned how we've seen such a big move coming in on defense shares as well, right? But on election day, that was the pocket that saw the brunt of the sell-off. But here on, do you think the rally is being led by FOMO now? Because, we saw policy continuity, that's a message came out of a coalition government. So valuations-wise, would you still say that, one could look at entering these stocks?
The problem with defense stock is that the largest poi for stocks are all PSUs. The floating stock is almost negligible because whoever has bought it is keeping it. Whatever mutual funds are coming in defense sector and the new one launched last week, they have to go buy the same stocks. So I don't know whether it's a momentum frenzy, but the fact is that till the government starts to supply more paper in the market, you don't have substantial defense stock availability in the market. Nothing to do fundamentally, you're in a good ticket because orders are going to go up. Now, whether you get the same margins, whether it's priced to perfection, I don't know the answer. The answer is there is no floating stock of paper for defense companies in the market, and the 4 or 5 new ones which have come up don't have that much liquidity. So, it's very nearly the fact is it's too much money chasing too few paper in the market. Until the government doesn't dilute, we will not have floating stock to come into the market. So, it's a steady story. It's a good story. You don't see a sell-off happening. Now, all the tick boxes get ticked off in terms of the holding the defense portfolio. Now, this FOMO issue, whether you should buy or not, I keep saying that what happens, we look from always a perspective of people who are as old as me. What happens if somebody is entering the productive cycle now? He has to start buying today. It doesn't matter to him, Mazgon was available at 400 rupees less than 2 years back. He has started his earnings today. His first SIP goes today or first equity buys today. So, forget the past. I think forget the FOMO. All this is dead. The election day proved to you that even if you had FOMO, you were too scared to buy that day. So forget all that. You will never capitalize on a huge market eventuality which happens off and on. You'll never capitalize it. You will always be out of the market. So buy, assume that future is good and wars will be fought and the defense equipment industry will do well. And hopefully India, with the kind of 26 to 22% rise in advance tax, that augurs well that the earnings people are projecting the earnings to go by 22 to 26%. That's a lot of money in the economy. Yes, argument against too much of a concentration, K-shaped recovery, etc. But that's another audience to talk to. Today's audience says the 22% advance tax increase says that you are looking at the earning sector of the economy growing by 30-40%.
Right. So what happens to consumption? We saw a rush to safety when everything was falling, but FMCG once again, has been under some bit of a selling pressure. But would you say that this is the right time to also increase exposure to these stocks in terms of safety?
The problem today has become there's too many stocks options available to investors, too little money. I think that's where the problem coming. That we need to find ways, where do we get this money to allocate to FMCG? You need to take it from defense, or you need to take it from infrastructure, or you take it from capital goods, or you take it from, let's take the AC companies, or you take it from the power company. Where do you allocate capital from? Standalone, there is no problem with FMCG. They're tested, time tested over 3 decades. They have given good returns to investors and good dividends. So if you're looking at long-term perspective, anybody entering the market, you cannot ignore FMCG at the end of the day. India is going to consume 1 billion, 1.2 billion people eating whatever they eat and whatever they consume, and the toothpaste and the whatever shampoos they use or soaps. It's not a small market. You need to be part of FMCG. The question comes, how much do you allocate to it? Do you allocate what you do earlier, 30-40%, or allocate 10 to 20%? I would be on the side of 10 to 20% because two reasons. One, the K-shaped recovery tells me a different set of stocks will move faster, so your return on capital is better. The number two is that the FMCG company itself are facing a very competitive market internally among themselves, and with the online, the discounts and all put together. So they have a challenge on the margin as well. So momentum is not with them at this point of time, but experience tells us these stocks give good returns to investors over a long period. So please be there. But it's not a time where you go 40% FMCG. It's a time you remain at 10 to 20%, not more than that.
Right, within the auto pack, I want to ask you, we've seen some bit of changes in the pecking order happening, right? M&M overtaking Tata Motors in terms of market capitalization, and now with Hyundai also filing its IPO. Do you think there is further, change expected in the pecking order when it comes to the auto pack? Intense competition, what have you? Do you think that would make the leaders a little uncomfortable going forward?
Well, auto has two components, really speaking. The end product companies, like the car companies, the two-wheeler companies, and there are the huge amount of auto ancillary stocks. What we have seen in the last 2-3 years, I think both segments have done well. Hyundai's IPO is a good thing because he's export-driven. For the first time, we're having a company which is 24% of Hyundai is exported at this point of time, which means that the Indian ancillary market is now getting benefit of even the global export market. And I can tell you, it is just the beginning. Export of auto component is still at the entry stage at this point of time. We will become the largest suppliers in the world, I can tell you, next 5 to 7 years. There's no need to worry about the valuation of at least the auto ancillary parts, I think, because they will have a huge market, including the replacement market for themselves. So that runway is very clear. Now, the runway for the auto companies in India is that's why I said very important. It all depends on GST. If they rationalize, entry-level vehicles start to get the traction, the market can explode by 20-30% or 40% in volumes at this point of time. If that doesn't come through the GST, the cost of holding the vehicle at the entry level is not dropped dramatically, this market will kind of go on, but go on the upper end. So net summary is auto ancillary stocks, you don't need to worry about whether there is anything happening because export market has opened up and lots of stock has done wonders to it. That segment you must continue. Now, whether in the end user automotive segment, you're going to get the returns that you got in the last 12 months, I would tend to wager my money on the two-wheeler companies because I think they will get the benefit in this GST rationalization. Given the political imperative, it's, I think, optically correct to give the benefit to the lower end of our consumption society than the upper end. So my bets are on that at this point of time. Two things are going to happen. Hyundai IPO is a great positive. Number two is two-wheelers are still remaining a very good bet.
Well, also, shift your focus to the IT space. You've seen what or how the Nvidia phenomenon has really played out, right? The stock has, I think, surged 9 times since the end of 2022. And on the other hand, Indian IT stocks, have underperformed, right? Because there's no, visible improvement in the discretionary demand scenario. But how big will the AI opportunity turn out to be for the Indian IT players? I mean, going forward, of course, till the time rate cuts kick in, you can't really expect any kind of improvement in the discretionary demand scenario, right? So here on, what would drive Indian IT stocks, and should one look at getting into it right now because of the valuations that they offer?
IT, luckily, unluckily and luckily, two things have happened. Indian companies have done a great job in terms of IT outsourcing. But as always, like Indian MNCs in India, they became the safest kind of bureaucrats in the world that we will keep following the pattern. So, to compare them with Nvidia is, I don't know who to insulting or giving really good benefit to the Indian IT companies. Indian IT companies did not invest enough, are not on the cutting edge of this point. They are a pure play services company, and they will have a role to play in the AI. Unfortunately, and that's where the newer players are getting a bigger bang of the buck. If you see some of the smaller companies in India and IT companies, the results have been spectacular, growing 28-30%, all focused on Indian market. For good reasons, the big IT companies never focus on Indian market, except TCS, which now has a recent amount of money coming to Indian market. So I think, if you, again, back to the same point, Nandita, that if you need to allocate capital today, why would you allocate capital to the top three of the Indian IT companies? Nothing spectacular is going to happen to them. They're not going to be part of the Nvidia, Microsoft, Google kind of environment at this point of time. They will never be because they're too timid. They're just too timid as a companies to keep themselves to the older and we'll keep doing services, we'll do things. They're not innovating. They're not doing anything spectacular. They're not in the new technology. They're not done investment in new companies in the US. If you look at Indian companies, they're sitting on cash in fixed deposit. And while the US companies are putting money into new companies, new setup, you saw Microsoft putting 10 billion in open AI. But what do the Indian companies do? Oh, we need to pay dividends to our shareholders so they can invest somewhere else. Fundamentally, the Indian IT model has done a very good job, will do a very good job. It used to be earlier called the retirement and widows fund, that you keep getting income every quarter. But is it going to be exciting space? Answer is no. I don't think we need to worry about them at all. They will keep doing well off and on. They sometimes will get orders, not get orders. AI space is going to be dramatic, but AI space will be captured by newer players, not by these behemoths, because they will be left far behind. So if you look at long term, I don't think one needs to peg the net worth on these kind of companies at this point of time, purely because they are timid companies, not willing to invest enough, too focused on dividends, too focused on safety. That's the only thing I can say.
Well, that's a very interesting point you made, Ajay. But lastly, if one has to look for value in this market, where should one look for it? What are your thoughts on private banks? Should that be one space because of the kind of underperformance we've seen from names like HDFC Bank and the likes?
It's a logical answer to say that how can the premium banks be driven by such poor valuation? And again, I keep saying the same thing, timidness. Of course, HDFC is a different story. They had to bail out HDFC Limited. But other banks have been too timid. Why the fintechs came and picked up the entire pie from the table? Because the banks of India have been too timid thanks to RBI's policy. They did not give new licenses. So, you don't worry about competition. Don't do anything different than what you're doing. Mr. IT company, same thing happens there. They just missed the bus on fintech at this point of time. And I think that's where the problem coming up. That Indian economy by and large is raising equity by the day. How many QIPs are coming, IPOs are coming and so on. What does it tell us? It tells us that any promoter would rather raise equity than debt given our stringent debt recovery requirements. Therefore, these banks have to reinvent themselves. They need to reinvent themselves to be far more automated, far more fintech driven, far more addressed to the market technology reality. And each of them fails on technology parameters, so they need to invest a lot of money. So, short answer, it's a very good investment because they are behemoths, you can't replace them overnight. The shorter answer is, are they exciting enough to give you the return in a year where your alternate investment avenues are giving such superior returns with such exciting prospects? New companies are coming up in the market. You saw what Azad did. You saw what new companies are coming and doing. Why would you want to allocate capital to these giants which are moved on slowly, ineffectively for your returns? So the point is, Nandita, everything may go up in a booming market. The question is, what is your rate of return on capital, and are you invested in the right stocks capturing it? Everything goes up. Doesn't matter. Every stock will be up at the end of the year, whether HDFC Bank, ICICI, or X, Y, and Z. Question is, did you allocate your capital wisely? Will these banks give you the alpha returns? The answer today at least looks like no, because they are slow-moving, behemoths, not investment, risk-averse banks, and that don't give you exciting returns. Growth companies give you exciting returns. Power companies give you exciting returns.
So top three sectors where one must be invested, according to you?
See, defense is a given answer. You can't ignore defense. Second is, of course, power is the second sector, and infrastructure is the third sector, where luckily and unluckily, not many players. MNCs literally have a monopoly on some of the products that India needs for the infrastructure, whether it is power, whether it is railways, and whether it is diesel engines. 3 or 4 companies straddle the whole market of infrastructure. So between power, capital goods, and defense, you got a wonderful sector. And the fourth I would try to add is the new age companies. I think some of them have done well, some of them will continue to do well. So this 4 bucket, I think, is the best momentum stocks that we think of for the next 12 months.
All right, that's the view then. With that, Ajay, I'm afraid we are running out of time, but I would like to thank you for taking out time and joining in. Always a pleasure chatting with you, Ajay. So many great insights. Thank you. With that, let's go back to Rajesh, who's been waiting by pretty patiently. Rajesh, let's take up some viewer queries then. Rakesh wants to know, whether one can add ITC in their portfolio just yet. Should he enter at current levels? It's a fresh entry.
So if he wants to buy ITC for investment perspective, yes, he can buy and accumulate. Though still the stock is in consolidation range. So really the major rally will takes place only above 440, 450 kind of zone. So once the stock crosses those level, then we can expect some rally towards 480 to 490 kind of level. But if he wish to buy for for a little longer period or for investment, he can buy and accumulate as the long term structure is bullish. But for near term to short term, stock may remain in consolidation for some more time. His stop loss should be placed at around 415 to buy ITC.
All right, that's the view on ITC. Hope that answers your query. The next one is coming in from Adit Taneja. He wants to know your thoughts on an NHPC for the short term. NHPC, I think in the last 1 month has fizzled out. Over the last 6 months, a good 55% kind of returns, but in recent times it has been stuck in a downtrend. Today as well it's down somewhere around 1.5%, but at levels of 100, would you advise entry for the short term?
So stock on the longer term chart, yes, stock is bullish. Though some profit taking is happening from higher level, we still believe that till stock is holding above 90, 92 level, trend is likely to remain on the bullish side. So if you wish to add in this decline, you can add further more position. Your stop loss should be placed at around 90 rupees. So you can use this decline as a buying opportunity in NHPC. Overall structure is bullish. Once again, stock manages to cross over 104, then possible target on the short to medium term perspective, we can see towards 120 to 125 also.
All right, that's the view on NHPC. Hope that answers your query. There is another query coming in from Abhijit. This one is on Bajaj Finance, whether it warrants a buy at current levels. He hasn't really mentioned his time horizon, but we have a brokerage note this morning on this particular stock as well, where Bernstein has initiated a market perform rating, target price at 6,800 rupees per share. Of course, a major overhang was removed when RBI lifted a ban from 2 of its products, right? The stock has been in an uptrend over the last 1 month or so, but the target outlined by Bernstein is still lower than where the stock is right now. So here, if one has to think long term for Bajaj Finance, what is the level that you will be watching out for?
So Nandita, still underperformance is there if you compare with the peer companies. Bajaj Finance is still struggling to cross its major supply zone, which is placed at around 7,500, 7,600 level. That's the major challenging level. We have seen multiple times stock, attempted to cross those level, but supply pressure is continuously hanging around those level. So major rally will takes place above 7,600 once stock crosses those level. Then possible target we can see towards 8,000. That's the next major, resistance area for the stock on the higher side. On the downside, the major support is placed at around 6,800. That's the level needs to watch closely. If stock slips below to 6,800, then we may see further more pressure in the stock prices towards 6,500, even 6,400 also. So we believe that some more time we may see a consolidation in Bajaj Finance. Still, near term, short term structure is still not that much encouraging. Supply pressure still exists on the near term chart also. So those who wants to buy for little longer period, they can buy an equivalent at this moment. But for trading perspective, I think one should avoid it this.
Okay, avoid Bajaj Finance with a trading perspective, but if you are a long-term investor, perhaps you can look at it. But a couple of more queries I want to quickly squeeze in. Viru Paksi wants to know your thoughts on Aavas Financiers, whether it should be bought at current levels. The stock is very close to its 52-week highs. In fact, housing finance companies, have seen an up move given the fact that the government, has announced some bit of incentives for this particular sector. But going forward, Aavas Financiers, a 20% kind of an up move coming in over the last 1 month itself. Is it prudent to look at buying at these levels or wait for dips?
So I think, Nandita, if you look at the monthly as well as on the weekly chart, stock managed to be breakout of its falling down sloping trend line on the monthly as well as on the weekly chart. That clearly shows that trend reversal sign is there on the stock. So now if the stocks holds above 1850, then possible rally can extend further. Though stock has moved up already 20% on a monthly basis, but still we believe that it was the kind of momentum which we are observing on on the same sector as well as in the broader market is also behaving on a bullish momentum. There could be another round of rally towards 2000 to 2050. So I think those who have already bought the stock can hold the position with stop loss of 1860.
All right, that's the view on Aavas. Hope that answers your query. The last query for today, this one is coming in from Abhishek Singh. He wants to know which is the best fertilizer stock to enter. The kind of rally that we have seen in fertilizer stocks, again today we've seen stocks gaining somewhere around 5 to 7%. Yesterday, fact was, up somewhere around 11 to 12% or thereabouts. Of course, there would be some bit of focus on fertilizer in the upcoming GST meeting as well. Would you suggest, riding the momentum here? And if yes, which is the one stock that's looking the best chartically?
So I think FACT and RCF both stocks are looking promising. So here if I need to give only one stock, so I'll go with the FACT only. The strong breakout is taken place on the monthly as well as on the weekly charts. So the way stock managed to give breakout of last 4-month consolidation range, we believe that this rally can extend and possible target towards 1040, 1050 we can see in a short period of time. So fact is a buy with stop loss of 895.
All right, that's about it for the viewer query segment. With that, Rajesh, would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. Look forward to our next chat.
Sure.
Well, with that, we fizzled out from the open markets just about in the positive zone, but the mid-cap index has slipped into the red. In fact, it's down 0.7% as we speak. The Nifty Bank Index, 50,950 is where it's at. It's up 1%, so very close to that 51,000 mark as we speak. So, that's the pocket that's been driving the up move in the last two sessions. Let's see whether or not the Bank Nifty manages to make a dash at its all-time highs or not, because it's still some 300-400 points away from its all-time highs. But in fine fettle as of now, mid-caps taking a breather, but private banking names doing well. The likes of Indus Towers, ICICI Bank, Kotak, Axis, HDFC, all 5 gainers on the Nifty 50 index are from the private banking pack. But with that, completely timed out on this edition of Opening Bell from me and the entire team. Thanks a lot for tuning in, but you guys stay tuned to Money Control for all your other news and updates, and have a great day.